We're joined today by Gary Rohloff, who is the Managing Director of Laybuy. Laybuy confirmed this week that the company has successfully raised $35 million from new and existing institutional shareholders. Now, Gary, the reality is that buy now, pay later companies require capital to grow. I mean, almost $2 billion was raised in the second half of 2020. Laybuy is on a strong growth trajectory. Was raising capital always part of the plan?
Tim, hi, and thanks for having me on with you today. It's always good to chat. Look, we have been contemplating a capital raise since the beginning of the year. Our advice was that, look, the market's in a little bit of flux at the moment. It's come off a little bit. You better to wait. With the benefit of hindsight, we wouldn't have waited because, as you're aware, all the buy now, pay laters have come off their peaks of January by about 50%. And as a market participant in that sector, we haven't dodged that. So look, with the benefit of hindsight, we would have gone earlier. We are in hyper growth mode. As you know, we grew 500% year on year in the UK, and we've got a trajectory that will see us growing by a significant volume in that market again this year. We're on target to hit $1 billion in GMV for FY22. So yeah, we need the capital to fuel that growth.
And what sort of new shareholders entered the register?
Yeah, look, we were really heavily supported by our existing institutional base, which is great. They have a lot of faith in the company, and their support was hugely appreciated. Part of the goal too was to slightly rebalance our register. We are quite retail investor heavy, and we wanted to just have a little bit of a rebalance there, and we've achieved that with what we have put in place. We've also got an SPP though for our retail investors that has been launched as part of this raise.
Now, Gary, and the whole buy now, pay later sector has been under pressure. As you said, you've got Afterpay down, almost 50% post its 21 highs. Same with Zip, same with Spurt. Laybuy has obviously had its own challenges since your ASX debut. So obviously you're not alone in terms of the sell-off. Why do you think the sector has been under so much pressure?
I guess, you can say timing's everything in life, right? And, we were ready to go with an IPO in January, February of 2020. I was actually on a roadshow and in San Francisco when I had to fly home because of COVID. And had COVID not hit for another month or so, we would have been a different place. And we listed in September. And it's fair to say the market has been somewhat under pressure since that time. I think there's a number of things contributing here, not least of which is the spectre of inflation in the US that has seen Treasury bond yields go up. Risk-off tech stocks are more of a switch to growth. And I think a lot of people have said, post-COVID, buy now, pay later takes a bit of a dive. I think what people are misunderstanding is that all of us within this sector offer an in-store solution. So when people are switching from online to in-store shopping, they're still going to pay by Laybuy. And we've seen it in New Zealand. Pre-COVID, our in-store transactions accounted for 10% of our GMV. Post-COVID, now that New Zealand's opened up, that's jumped to 25% of our GMV. So customers who hadn't paid by Laybuy pre-COVID experienced us during COVID online, and now they've gone back in store and are paying by Laybuy. So our tap to pay solution is going to be a huge boon to us in that bricks and mortar world. But as an overall sector, as you quite rightly point out, it's been risk off since the beginning of the year, really. Markets are cyclical. It's had a heck of a run, and we're still knocking down our numbers. We're twice the size the company was on listing, but the share price is halved. So I feel a huge responsibility to our shareholders. And I feel terrible that the share price has gone where it's gone. And I would also add, we're the largest shareholders, our family, so we haven't dodged this bullet either. It's been a hell of a painful ride, but we've just got to focus on what we can control, and that's delivering on our numbers, which we're doing. So, and I'm sure everyone else in the sector is focused the same way.
And Gary, it's a competitive sector. So how does Laybuy differentiate itself?
One of the key differentiators outside of the obvious, which is we're a weekly payment cycle, and in the UK, that is a differentiator because our competitor set are fortnightly or monthly. So from a retailer's perspective, they're offering their customer choice. We've also got a couple of unique products, Laybuy Boost, which I've spoken with you about previously, I think, but that allows consumers to spend more than their lay-by limit in one seamless transaction. And we're currency agnostic. So for retailers who ship into Australia and New Zealand out of the UK, they can access our consumer database and they don't need a New Zealand or Australian bank account or website. We deal with the FX. The other thing is we have rolled out our MasterCard Tap to Pay facility in New Zealand and Australia. That was enabled in the UK pre-Christmas, but we're rolling it out now late May, early June, as the UK comes out of lockdown and stores are opening and people can start to get out and about without that severe social distancing. So that in-store is going to be a significant boost to us. I think the other thing that we've really tried to do since the day we started our company was demonstrate that we are a responsible lender. We don't resile from the fact that we extend credit, despite the fact it's interest-free, but we have always credit and affordability checked our customers, or credit checked in New Zealand and credit and affordability checked in the UK from day one. So the recent Woolard review that implied that the recommendation was that Buy Now, Pay Later became part of that ecosystem that independently credit and affordability check and report through continuous credit reporting. We're already part of that. And that is a key differentiator for us in the UK because we have set ourselves apart as being a responsible lender.
And Gary, your focus has always been post New Zealand, has always been the UK opportunity, and you put in place recently some strategic partnerships. Can you talk to that, please?
Yeah, sure, Tim. The UK market's massive, and I think it is underestimated by many. It's a £400 billion retail market that we can access. What we've done is we've entered into partnerships with Rakuten, AWIM, and a company called Sovereign, spelled SOVRN. And through those partnerships, they will allow us access and our consumers access to pay by lay-by at over 5,000 retailers in the UK. And those names include Marks and Spencer, Amazon, eBay, Adidas, Nike, Booking.com, etc. So these are B&Q. These are massive, massive brands. It means that we scale from our current 2,000 odd retailers to 7 rapidly and gives our consumers the opportunity to pay by lay-by online. And where some of those stores have a physical presence in store too with our Tap to Pay. So we're really excited about that, what that does. And obviously the recent raise will help fuel that growth as well.
Gary, always good to talk to you and look forward to talking to you later in the year.
Thank you, Tim. Always good to be part of this. Thanks. Bye.